Pakistan is facing a financial crisis. The country is struggling to pay its bills. One of the biggest problems is the soaring cost of interest payments. In fiscal year 2023 to 2024, Pakistan paid a staggering 8.2 trillion rupees in interest. This represents a 43% increase from the previous year. This surge in interest payments is alarming. It is putting a strain on the country's finances. The situation is unsustainable. Pakistan is caught in a debt trap. The country has to borrow more money just to pay off old debts. This leaves little room for essential spending on education, healthcare, and infrastructure. The high interest costs are hindering economic growth. They are also exacerbating poverty and inequality. The roots of the crisis run deep. Years of economic mismanagement, political instability, and corruption have taken their toll. The COVID-19 pandemic and the war in Ukraine have further worsened the situation. These global events have disrupted supply chains, fueled inflation, and increased borrowing costs. Pakistan is at a crossroads. The country needs to take decisive action to address its debt crisis. Failure to do so will have dire consequences for its economy and its people. The international community must also step up and provide support to Pakistan. A coordinated effort is needed to help Pakistan navigate this challenging period and achieve debt sustainability. Several factors have contributed to Pakistan's high interest costs. One key factor is the country's high level of public debt. As of June 2024, Pakistan's total public debt stood at 71.2 trillion rupees. This is equivalent to 67.5% of its GDP. A significant portion of this debt is domestic. Domestic debt accounts for 47.2 trillion rupees, or 66% of the total debt. The high level of debt means that Pakistan has to pay a lot of money in interest. The average time to maturity of domestic debt is only 2 years and 8 months. This means that Pakistan has to refinance its debt frequently. This exposes the country to interest rate volatility. Another factor driving up interest costs is the high interest rate environment. In 2024, the State Bank of Pakistan's policy rate reached a peak of 22%. While the SBP has since cut interest rates, they remain relatively high. The high interest rates are a reflection of the country's economic challenges. These challenges include high inflation, a depreciating currency, and a large current account deficit. The depreciating currency is another major concern. The Pakistani rupee has lost significant value against the US dollar in recent years. This makes it more expensive for Pakistan to service its external debt, which is denominated in foreign currencies. The weak currency also fuels inflation, as imported goods become more expensive. Pakistan's debt burden is a complex issue with a long history. The country has a history of accumulating debt, often to finance large infrastructure projects or to meet budget deficits. The composition of Pakistan's debt has also changed over time. In recent years, there has been a shift towards more domestic debt. This is partly due to government efforts to reduce reliance on foreign borrowing. However, the high level of domestic debt also poses risks. It can crowd out private sector investment. This is because the government is competing with businesses for funds. The high domestic debt also increases the risk of a domestic debt crisis. This could happen if investors lose confidence in the government's ability to repay its debts. External debt, while a smaller proportion of the total, also presents challenges. Pakistan's external debt stands at 24.1 trillion rupees, or 34% of total public debt. The country is exposed to exchange rate risks. Fluctuations in global interest rates can also impact Pakistan's external debt servicing costs. A major concern is the lack of transparency in Pakistan's debt management practices. There have been delays in publishing key debt-related documents. This lack of transparency makes it difficult to assess the true extent of Pakistan's debt problem. It also undermines accountability. Pakistan faces an uphill battle in managing its debt and reducing its reliance on high-cost borrowing. The government has announced plans to explore alternative funding sources. These include issuing green sukuk, asset-light structures, and panda bonds. Pakistan is also considering debt swaps, such as debt for nature and debt for climate swaps. However, these measures alone are unlikely to be sufficient. Pakistan needs to implement comprehensive economic reforms to address the root causes of its debt problem. This includes tackling corruption, improving governance, and creating a more business-friendly environment to attract investment and boost economic growth. The recent interest rate cuts by the State Bank of Pakistan are a step in the right direction. Lower interest rates can help to stimulate economic activity. They also reduce the government's borrowing costs. However, the effectiveness of monetary policy is limited. Without addressing the underlying structural issues, Pakistan is likely to remain trapped in a cycle of debt and economic instability. The impact of Pakistan's debt crisis is being felt most acutely by ordinary citizens. The high interest costs mean that there is less money available for essential public services. Inflation is eroding purchasing power and pushing more people into poverty. The depreciating currency is making imported goods, such as medicines and fuel, more expensive. Addressing Pakistan's debt crisis is not just an economic imperative, it is also a moral one. The international community must provide support to Pakistan in its efforts to achieve debt sustainability and create a more prosperous future for its people. Failure to do so will have far-reaching consequences, not only for Pakistan, but for the wider region.